Every day, trillions of dollars move around the world. Almost none of it moves the way you think it does. When you send money across a border, nothing physically travels. No cash crosses an ocean. What actually happens is a chain of institutions updating their own private records, one after another, each one waiting on the one before it. Understanding that chain explains almost everything people find frustrating about money. These are the 10 levels of moving value, from a suitcase of cash to a settlement network that clears in seconds. Level 1. Cash. Physical currency is the only form of money that settles instantly and completely. When a banknote changes hands, the transfer is final. There is no clearing, no reversal, no intermediary. That finality is the reason cash still moves enormous volume worldwide. Its limitation is equally absolute. Value moves only as fast as a human being can carry it, and only as far. Cash cannot cross a border without a person crossing with it, and most countries require any amount above a set threshold to be declared. Level 2. Informal value transfer. Long before modern banking, brokers solved distance with trust. A sender hands cash to a broker in one city. A second broker pays the recipient in another. No money crosses the border. What crosses is an obligation, settled later between the brokers, often by offsetting flows moving the other direction. The system is fast and inexpensive, and it operates where formal banking does not exist. It depends almost entirely on reputation, keeps no audit trail, and in most jurisdictions, operating one without a license is a criminal offense. Level 3. Money transfer operators. The storefront model is the same idea rebuilt as a regulated business. The operator holds funds in both countries, accepts cash on one side, and pays out from local reserves on the other. The customer receives a receipt, a reference number, and legal recourse. That protection has a price. The World Bank has tracked global average remittance cost above 6% for years against a United Nations target of 3%. Much of that cost is not profit. It is the price of keeping real money sitting idle in every country the operator serves. Level 4. Bank rails. Inside a single country, a domestic payment system moves value between banks that all hold accounts at the same central bank. Settlement is simple because one institution sits at the center and updates both sides of the ledger. Many countries now run instant rails that clear in seconds at any hour. The moment a payment leaves that shared center, the simplicity disappears. Level 5. Messaging. This is the part most people misunderstand. The international messaging network that banks use is not a payment system. It moves no money at all. It is a secure standard for sending instructions, with tens of millions of messages a day, and every one of them is a letter rather than a transfer. The message arrives in seconds. What follows, it does not. Level 6. Correspondent banking. When two banks have no relationship, they route through an intermediary that has a relationship with both. To make that work, banks hold accounts with one another and pre-fund them with real currency sitting in a foreign country, unavailable for anything else. Every additional hop adds an institution, a fee, a cutoff time, and a compliance review. A payment routed through 3 correspondents is genuinely processed 3 separate times. Since the financial crisis, many banks have withdrawn from these relationships in regions they consider high risk, a pattern regulators call de-risking. The constraint at this level is not technology, it is balance sheet. The scale of that idle capital is the part that surprises people. To be ready to pay out in a currency, an institution has to hold that currency in advance. In an account it does not control, in a country where it may have no other business, multiply that across every currency pair a large bank supports, and industry estimates put the total sitting still at any moment in the trillions. None of it is lost. All of it is unavailable. That is the real price of a system that settles by updating separate private ledgers rather than a shared one. Level 7. Card networks. Card systems solved consumer payments with a closed loop that authorizes in about 2 seconds. The distinction that matters is between authorization and settlement. The merchant sees approval almost instantly, but the funds themselves move later through a batch process, and the network absorbs the timing risk in exchange for fees. It is an elegant solution for retail purchases, and it is not designed for institutional value transfer. Level 8. Netting. Modern payment companies observe that most cross-border flows have a mirror image traveling the opposite way. Rather than moving money across a border, they match opposing flows and settle locally on both ends. The customer experiences a fast, transparent, inexpensive transfer. In practice, their money never left the country. The method depends on balanced flows. In corridors where value moves overwhelmingly in one direction, someone still has to fund the imbalance. Level 9, global settlement and tokenized money. A dollar-denominated token on a blockchain can move continuously without cut-off times or correspondent chains and settle in minutes. Settlement volumes in this category have grown substantially. The trade-off is a change in the nature of the risk, not its removal. A token is a claim on an issuer, and it is only as reliable as that issuer, its reserves, and the regulatory framework it operates under. Frameworks for these instruments are still being written in most major markets. Level 10. Bridge asset settlement. The persistent cost across every level above is pre-funded capital sitting idle in foreign accounts. One proposed answer is a neutral bridge asset. A sender converts local currency into the asset, transfers it, and converts into the destination currency on the other side without holding balances in advance. The XRP ledger was designed for this pattern, and it settles transactions in a few seconds. Ripple, the company most associated with it, has a chief executive, Brad Garlinghouse, and shareholders. The ledger has neither, and it keeps running regardless of what any company decides. The requirements are demanding. The approach depends on sufficient market depth in both currencies because a thin market can consume the savings through spread. It depends on regulatory clarity because regulated institutions cannot use an instrument whose treatment is undefined. And it depends on integration with the messaging standards banks are migrating to. This is one architecture among several being tested, not a settled outcome. So the pattern holds across all 10 levels. Cash settles instantly and cannot travel. Informal networks separate value from movement and depend on trust. Regulated operators add protection and pay for float. Domestic rails are fast because one ledger sits at the center. International messaging standardized the instruction, not the settlement. Correspondent banking made settlement global and immobilized enormous capital to do it. Cards made authorization instant for consumers. Netting removed the border and requires balanced flows. Tokenized money made value continuous and introduced issuer risk. And bridge assets target the pre-funding directly, if liquidity and regulation permit. Speed, settlement, liquidity, regulation, and adoption are 5 separate questions. A system can be fast and still fail to settle. It can settle and still lack liquidity. It can have both and still be unusable without a legal framework. Most confusion in this subject comes from treating those as one question. Nothing here is investment advice, and none of it forecasts the price of any asset. Technology can change how money moves. It does not remove risk.